I know all of you have heard that there's been lots of changes in the interest rates and in the lending market. So I wanted to bring you information straight from a lender's mouth. So I hope you enjoy this interview with Jamie Myers from Golden One Credit Union, just to try to talk about some of the issues that I know everybody's wondering about and give you some information right from a lender's mouth. So enjoy.
Well, hello, everybody. I'm Linda Baker with Milestone Realty, and I wanted to have a one-to-one meeting with one of my top lenders. So please let me introduce you to Jamie Myers.
Hi, Linda. Thank you. I'm so happy to be here.
Well, thank you so much for talking with me. I know that there's a lot of confusion and uncertainty right now in the mortgage market, at least from the eyes of the buyers and some of the public. So I really wanted to get the real information out there so people can make decisions that will be best for them.
Absolutely.
So let's talk about the elephant in the room. What are interest rates doing now, and how have they changed this year?
So interest rates have changed a lot this year, and I don't think it's where the actual rates are right now that's so surprising as much as how quickly they got there. So in terms of, comparing to, let's say, December, I would say a 30-year fixed rate is anywhere from 2 to 3% over where they were in December, and
Wow.
an adjustable rate mortgage probably 1 to 1.5% higher from where they were back in December. And also something that's interesting to note is that conforming rates, meaning loans that in the Bay Area under 970,000, conforming rates have definitely increased more than jumbo rates. So you're also like conforming rates are going to be more in the 6%-ish for a 30-year fixed, and I would say jumbo are going to be more in the 5%-ish. All of those things obviously depend on lots of factors, but that's just kind of generally where you're seeing them right now.
That I know surprises me. I know I learned about that fact years ago when you'd probably educated me on that. But it's still, I'm sure for the general public, it's got to be a real surprise that we are paying a lower rate for a jumbo loan.
It is. It really shocks people to know that if they borrow more money, they can get a lower interest rate. It's an odd conversation to have with clients, but it's true. It's been true for a lot of the last probably like 5 years, but it hasn't been as different as it is right now.
Yeah, it's just crazy.
Yeah.
Now, do you think that rates have started to stabilize yet?
They are definitely not going up as dramatically as they had been kind of in the April, May-ish timeframe. We've gone a couple weeks without having any rate increases, which is actually incredible for this year. So, because normally for most of the year, we've gone up like 1/8% more weeks than not. So to have a couple weeks of it stabilizing, that's been great. I think also what's really happened is, I always say when there's a big increase in rates, there's kind of like a paradigm shift where people are all of a sudden like, what? I've been quoted, I keep expecting to hear 2 or 3 as the first, number in my rate instead of 4 or 5. And I think it's been long enough that the rates have been increased that it's not as shocking, and buyers have really gotten used to that, especially new buyers coming in. They were never quoted, a 2.875% 30-year fixed rate. So it's not as shocking to the new buyers that are coming in.
Well, I hate sounding old, but we have to realize that all those rates that were under 3%, I'm not going to use that word, was really a pandemic gift from the gods.
Absolutely. Yes.
Yeah, that truly was an anomaly, and that's part of what fueled the rates that have gone up as well, as much as they have.
Yeah.
So
I remember when rates were coming back down, like below 6%, kind of where they are now, and people were jumping for joy at the chance to refinance into a 5.25% interest rate. So, it's a different perspective after the pandemic mentality.
yeah. Well, with these rates changing, have the lending standards changed at all either?
So it's not that lending guidelines have necessarily changed, but I would say one of the biggest factors that has changed, not as a result of rates, but more as a result of the stock market decreasing, is how RSU income, or restricted stock unit income, ends up being calculated. That's a way that a lot of big tech companies compensate their employees, and a big factor in how that income is calculated is the current stock price. And so if your stock price goes down 25%, well, that portion of your income calculation could go down by 25%. So a lot of buyers are getting that dual, like, I'm qualifying at a higher interest rate, and also my income calculation is going down. And so those are the times that you're really seeing that maybe they can't qualify for as much as they could have previously.
Oh, that's really well, not to mention the fact that potentially their down payment has also partially gone away as well.
Yes, I've seen a definite interest in people that could put 20% down, but they're really interested in 10 or 15% down programs, just because they don't want to have to sell their stock right now.
Very interesting. Oh my God, I really am. I'm getting so much out of this already. Thank you so much for this.
You're welcome. Absolutely.
Well, so I'm curious. So, before people were all, when the rates were super low, everybody was doing 30-year fixed. We weren't even discussing adjustable rate mortgages.
Right.
Now,
if you could get a 30-year fixed below 3%, why do an adjustable rate?
But let's talk about that. What are buyers gravitating towards now?
A lot of buyers are gravitating more towards a 7-year ARM or a 10-year ARM, meaning those are still 30-year loan terms, but the interest rate is only fixed for 7 or 10 years and then begins to adjust. And I think the reason is that those are probably tracking, a half to a full percentage point below 30-year fixed mortgages. So
that's significant.
It's a significant in their payments. And I think the number one decision in terms of what is the best loan program is really how long you plan to be in the property.
Thank you.
If you plan on being there forever and you have a low risk tolerance and it scares you if your interest rate is going to adjust in the future, just do a 30-year fixed instead of an adjustable rate mortgage is my recommendation in that situation. I think there's a lot of times a lot of buyers don't plan on being there forever, and an adjustable rate mortgage is a great option for them, especially now where there's such a big differential. But I don't like it when people do adjustable rate mortgages to save some money and then they can't sleep for the next 7 years because they're worried about what will happen. So there's a trade-off, and I think it just depends on a lot of people's risk tolerance is the number two thing. Number one, how long you plan to be in a property, and then your risk tolerance on that.
Well, and I think it also depends if you're a first-time buyer versus you're a step-up buyer. I think for first-time buyers, it also depends on the kind of property that you're buying. If you're buying a condo or a townhouse, those tend to sell. You tend to turn over faster than if you're buying a single-family house. I know I was in my first single-family house for 11 years. So that really ties into what you're talking about, getting a 10-1 ARM.
Yeah, absolutely. The 10-1 ARM is my favorite loan program because I just think it's 10 years. It's a long time. It's a little bit longer than 7, but you definitely get a lower interest rate than the 30-year fixed.
Oh, totally. Yeah. Now, back in when the market was insane on fire, appraisals were an issue, weren't they?
They were. We saw at least a lot of potential appraisal issues in 2021 and in 2020, and definitely the beginning of this year, up through like March to April of this year. A lot of appraisal issues, meaning that the properties were not appraising necessarily for the purchase price. They were coming in under. And
then what would your buyers do?
Yeah, so when that happens, a lot of times it means that they have to increase their down payment. If they're starting off with a 20% down program and the property appraises for under the purchase price, the lender is going to only lend 80% of the appraised value. So it increases the down payment. If you started off putting down a very, very large down payment, then it may not have affected you at all if the appraisal came in below the purchase price. So it wasn't even on most of the properties, but there was always that worry because of how quickly the market was increasing in value, and appraisers can only really use the comps. They can't only use pending comps. So if they're focusing on closed comps, and if every week things are going up a little bit, there were a lot more appraisal issues. However, the good news is I'm not seeing that as much now.
Well, and let me just chime in though on the appraisals. What you didn't see, but I saw as a listing agent, is that I would tend to encourage my clients to choose buyers who had more money down. So the buyers who only had 20%, which is still a lot of money for the average purchase in Silicon Valley. But if you only had 20%, I probably wasn't going to pick you because I was concerned personally about appraisal issues. And so buyers who had more more down payment had a higher likelihood of getting the deal.
It's true. Yeah,
Yeah.
I'd say definitely the more money you have, the better. From my lender perspective, a lot of times people that are putting even just 10% down, they're putting 10% down, and that means that they have a lot more money to work with in the event the appraisal comes in low, because they're not starting off putting off all their money and they're already prepared to do a 10% down program. But I know from the purchase contract perspective and evaluating multiple offers, that's not necessarily what is perceived. But I want to throw a shout out to the 10% down buyers. A lot of times they're really well qualified.
100%.
I hope they get more of a chance this year.
100%. Well, what's funny is that, after the market started to really shift, we put 3 different buyers into homes that had, either just 20% or 15 or 10% down, because there was now less competition and we knew the prices were lower. So we knew that it would appraise. So we were able to make these deals come together. Yeah. It's a big deal.
It is. I have seen a lot more opportunity for some buyers that just didn't feel like they were able to compete in the market for the last, couple of years.
Yeah.
It's exciting for them.
Well, that kind of leads me to, what do you suggest buyers do now? I mean, do you think it's a good time to buy?
I almost always answer that question with yes, because I think that is based on your own personal, financial readiness to buy a house. If you have your down payment down, you feel like you are comfortable affording the payments, you think that you can buy a place that you can stay in for, medium to long term, that's when it's a good time to buy for you. I think appreciation values over the long run are always going to be good. So I'm not a big fan of people buying a property that they're going to grow out of in like a year or two. I think that could be a risky endeavor. But I agree. If you're right, if you want to own a home and have that responsibility and you have all your ducks in a row, yes, it's a great time to buy a home. Oh yeah,
I just had 2 people reach out to me that were ready to start looking for a home, and one of them's a family member. So it's like, people are now going, wow, I don't have the competition. I'm not having to bid hundreds of thousands of dollars over the asking price, or hundreds of thousands over the last sale that just transpired.
Yeah, absolutely.
So, awesome. Well, I am so grateful that you spent some time with me, Jamie. Thank you so much. I'm really looking forward to working with you again. Jamie's one of my best lenders. And if you need anything, we're going to put Jamie's information at the end of this Zoom. But thank you very much. And we really expect that this is going to be a great opportunity for a lot of people, especially those people who had been pushed out of the market because they couldn't compete number-wise. So,
yep.
Awesome. Thank you so much,
Linda. Have
a great day. Take care. You too.
Bye.
I hope you enjoyed my conversation with Jamie as much as I did and got some great information from it. If you have any other topics that you would like us to discuss, just let us know, because we want to make sure that we're here to give you all the best real estate information possible. Take care.